be on here. I'm going to get started because this is recorded, so they'll be able to chime in, but I do not want to keep everyone waiting. Thank you so much for being here. I did not want to do the intro this time because I usually do, but Regina and Farallon will be joining us shortly. So I really love this community. It makes me so happy to see some familiar faces and some new faces, but this is Onyx Wealth community. We're really priding ourselves on making sure we educate our community, right? I think to whom much is given, much is expected. That's like become my mantra. And I really, really feel like I've been super blessed to surround myself around people that really want to see me grow and excel in different things. So I'm just letting people in. Here's Farallon. So I'm excited to just share any knowledge I can with you about anything that has benefited my life, especially in an area where, you know, I can build wealth. So I can show you how I built wealth and how other people have built wealth and what you can do to continue down that path. It's not all about home ownership, but we do live in an area where to live here and rent here, you might as well own here. And it's important to benefit from that appreciation. And with that comes financial management, i.e. the last class we had with Desarte Yarnway, our financial planner, and now managing your taxes, because that's also a form of saving, right? So understanding how to manage your taxes in a way to make you appealing to lenders while also saving money where you can, right? So without further ado, I wanted to introduce all of you to Juan Montes. I will not do his intro much justice, but yes, he deserves a round of applause. You're gonna really love learning from him. I'm going to tell you a little story about why I think it's important that you understand how taxes can influence. I don't know who's. Does someone want to go on mute? I'm not sure who that is, but we'll talk a lot about how that can, you know, influence your finances. But one of the biggest reasons why I've grown to just love what he does and respect it is, you know, I've known him about 13 years now. I worked with him in tech, actually. And then he'll tell more about his story, but he went off to get his law degree and also start his own tax firm. And I was using the H&R Block, and I had a really good H&R representative. And once I was about to buy our first house, he said, you know, I'm not supposed to tell you this. I really like working with you over these last 4 years, but your tax profile is getting more complicated in a way that you can benefit from having a different type of tax professional to prepare your taxes. And so I put my feelers out there, and I remembered that Juan did this. So I reached out to him. And what I can tell you is that from, you know, that person who wasn't a licensed realtor, didn't have any property, was about to buy their first property, and the things he taught my husband and I, and how he found, you know, errors from prior years in our taxes or this and that, to now where we have a much more complex, you know, corporate tax return and personal tax return. He's really set us up in a place where we can benefit financially from making sure our taxes are done right, strategically, and legally. So I'm going to let him further introduce himself, but this is why he's super important to me. So Juan, welcome.
Thank you very much, Neka, and thank you for the kind words. I'm really excited to be here, and thank you all for giving me this opportunity. And please jump in and ask any questions at any point. Anything I say, you know, again, jump in, ask questions, and that's what will make this more interactive, more fun, because oftentimes tax is not the funnest thing in the world. And you know, we'll let this kind of go. So, as Neka said, I was in the med tech world, and that's where we first met. I was doing, at that time, I'd started preparing returns because somebody was making a lot of mistakes on my parents' returns and other people's returns in my family. And that's really why I took the classes I needed to at least be able to prepare their returns. So when I met working at Stripe, it was something I did on the side for basically friends and family. Didn't really see it as a business, but then left Stryker to finish law school. And once I finished law school, or actually 2 years before finishing law school, I said, hey, this thing can really be what puts food on the table. I enjoy it. I'm good at it. And, let's launch this firm and make it a full-time thing. And that's basically what I did. And the rest is history. So I guess I'd like to start by touching on what NECA mentioned about like H&R Block. H&R Block is a great service. And I think the way we all want to think about tax preparation and tax advisors is you want that the service being offered is a match for your needs. And I think that's where I oftentimes see a disconnect. So if someone has a very straightforward tax return, maybe even if they own a house, maybe H&R Block is a good fit, and you don't really have questions throughout the year, and you don't really have advice you need, and you really just go see that person at tax time and nothing more, then that could be a great fit, right? And I don't want it to feel like we're picking on H&R Block. So I'll say, tax firms that offer that type of service where they're there for you during the season, but then once April 15 rolls around or whatever their close date is, they kind of are unavailable for you the rest of the year. And, the type of service I offer is I work with my clients year round. In my fees, we've built in any questions people have. If it's, 10, 15, 20-minute call every now and then, that's part of the service. If someone's self-employed, then the fee they pay includes doing a few more things than just that. And what it is I really want everyone who I work with to know that anytime they're making a decision at any point during the year and they think there's a tax impact, or if they're unsure if there's a tax impact, they always want to reach out to me and ask me, because it's not going to cost you anything to ask me. And probably 9 out of 10 questions you ask won't cost you anything anyway, because again, it's built into that annual fee, and you're going to get the answers you need, even if it's hey, don't worry about it, it won't affect you at all, or hey, this is what you want to look out for. And that's something that you're able to avoid tons of mistakes. I mean, I could give you an example today, super heartbreaking story. About 2.5 years ago, I worked with a client who hadn't filed a tax return.
Sorry, hold on. Let me put them on. Okay, Juan, go ahead.
A couple of years ago, I worked with a client who hadn't filed a return for a couple of years, and she owned a few rental properties. And what happened is I caught her up. I helped get everything in order. We had a whole bunch of conversations. I mean, it was a project because she really had a lot going on. And then when it was time to prepare her 2019 return, she wasn't ready. So we filed an extension. She didn't, at no point during the year was she ready, and she just didn't do it. Then now 2020 return was due this year. And this time she reaches out and she says, hey, Juan, okay, I'm ready to file 18 return, 19 return, and I need to do 20. So 3-year project, basically, kind of quote unquote again. And when I said it's a sad story, is one of the properties that she sold had over $300,000 in profit. It was a rental property. And she went through the process of doing a 1031 exchange. She hired somebody called a qualified intermediary company. And I'll explain all of this because maybe folks may not know what a 1031 exchange is. So I'll explain that. But basically, if you have an investment property and then you exchange it, you sell it, and you purchase another investment property, you're able to defer the tax. You're able to defer paying Uncle Sam that money. Now, it doesn't mean it's possible you never pay the money, and there's some planning that would go into that. But at the very least, her, for example, $90,000 tax bill would be pushed out indefinitely until she did certain things. However, what needs to happen with a 1031 exchange is you have to sell an investment property, purchase an investment property, and then there's some deadlines and things that we don't necessarily need to discuss. But where her mistake happened is she closed on this new property and then she moved into it.
Mm-hmm.
And when she moved into it, she did what we call in the tax world, she blew up her 1031 exchange, meaning she can no longer defer the taxable income from the sale of her property because what she bought is not an investment property. And what ended up happening is she got stuck with a $90,000 tax bill. And the reason I throw this out there is when it comes to tax, you have to be proactive. You have to be forward looking. There isn't a lot you're going to be able to change once something's been done. So for example, if you need to do some planning for 2021, that planning cannot happen in January of 2022. It needs to happen between now and December 31st. And again, what happens, you know, for example, in her situation, if she'd have called and said, hey, Juan, I'm doing this, I'm selling my rental property, I want to do a 1031 exchange so I don't pay tax on the proceeds, on the profit from selling this, I would have explained to her and focused on the fact that she couldn't move into that house. And assuming she was able to meet the criteria and not move into that home, she would have literally saved $90,000, which she could then use to invest in more real estate or other, you know, whatever other investments she's after.
So can I jump in one? Let me, I want to break down just kind of what he went over to resonate with some of who I know is in the audience. So when he's talking about this 1031, let me paint a picture of how that can apply to you guys in the future and why that strategy and just that way of thinking about being proactive is important. Most of you, some of you are starting to buy a home, already own a home, maybe onto your second home. And so it's important for you to understand that once you get into that second home, that third home, and you make any of them an investment, right? You can only live in one property. The rich people, like we always talk about, right? What are the rich people doing? How are they saving so much money? How do they have so much money? Well, a lot of times there are these tax benefits that we don't know about. And this is one of them that isn't probably well utilized, but as Juan mentioned, when it's not used the right way, can blow up in your face. So when you buy that first property and then you're ready to trade up and you're making enough money, you've saved enough and you've set it up to where you can make that first property, a rental, and now you move into that next one, right? And this is how you accumulate, you know, you house hack for a little bit and then you accumulate properties and you start your investment track. When you decide to buy another one and you sell one of them, and that one that you're selling was a home that you had as a rental, and you're buying that next one, there are so many tax benefits that you can use rather than paying, you know, the taxes on $100,000 gain, right? You can essentially pay almost nothing on that gain to the government because you are trading into a new property that you're not going to live in. You're going to have it be an investment property. So that's this 1031 idea. So I love that example that you brought up, Juan, of just, you can only not have that situation blow up in your face if you are being proactive and asking the right questions, because there's so many situations in life that have tax implications and you're not going to know what you don't know. So when you have a good tax person that does have your back every single month, not just in April when it's time or whenever, say for business taxes, when it's time to file, you can be proactive and really make some strategic choices. Can I ask you a question, Juan? So what exactly, because a lot of times when I think my tax person, sometimes I want to just call you my CPA, right? Tell me, what is the difference between a CPA and a enrolled agent? Because as we all know from the description, you are an enrolled agent, federally licensed. So can you break down what that actually means and what the implications are to us?
Yeah, absolutely. So to the client, there is no implication from the perspective that whether it's a CPA, enrolled agent, a tax attorney, or in California, there's also something called a CTEC registered preparer. So there's 4 different people that can help in the tax area in California. To the client, the licensure is mostly transparent. So what you really want is that making sure that that person is experienced in the areas you need them for. But to be specific on the difference between an EA and a CPA, is CPAs are licensed by the state of accountancy of whatever state they reside in, and enrolled agents are licensed by the US Treasury. So it's a federal license, and I can work and prepare returns in any state, basically all across the country. We both have full representation rights. Enrolled agents typically are focused on taxation. And I know everyone, when they think tax, they think CPA, but the reality is that the majority of CPAs, there's a ton of CPAs that are in private industry, like let's say corporate America, things of that nature, where they actually have nothing to do with tax. So they're more of like the internal accountants at organizations more than anything. Now, of course, when you see kind of customer facing CPAs, they are tax focused like enrolled agents are. So the big differences are that is who they're licensed by. And then the other thing that's different is sometimes, and unless you're a business with certain types of investors or a publicly traded company, you have to deal with something called audited financials, meaning that somebody's gone in there, verified every single number, and then they sign off and say, I have verified the books of this organization, and I attest that these are true and correct because I've done a formal audit of their books and records. That's something a CPA firm would do, and that's something enrolled agents don't do. But like I said, that's more for certain types of businesses with very specific types of investors, SEC regulated type entities, think of hedge funds, things like that, and of course, publicly traded companies. And again, that's more of an accounting thing than it is a tax thing. And that's why, as I had mentioned before, CPAs are primarily accountants and some dabble in tax, and EAs are primarily tax people who may or may not do accounting.
Okay. One thing that I think is critical in that is there are some people, I'm not going to call you out, but I know there are some people in this room, in this webinar that are, onto their third, fourth, or fifth property. And I know some of them are considering buying out of state. And what I think is cool, because, Calvin and I just bought a fourplex in Kansas City. And what I love is that I don't feel like a fish out of water when I'm talking about, how my taxes are going to be affected as it relates to that Kansas City property, because I know that Juan, handling our taxes, understands what he needs to know about the taxes in that area and how they affect me living here in California, where he also lives. So I think that's important to understand, is just as you grow your portfolio, and if you go out of state, it's cool to have a tax rep that can go outside of the state to understand all the implications so that you're not caught in a situation where they're flying blind and don't understand how it affects you. So great. Next question. Well, you kind of answered this one. Can you do taxes in other states? And the answer is yes, from what you just talked about. So why, you touched on this a little bit, but I want to kind of drive it home on, how proper tax planning and prepping and being more involved, throughout the year can really affect someone who is on that home buying track. So for example, why is proper tax planning so critical prior to buying a home or any additional investment homes? And just kind of a horror story on my side to draw a correlation here is, I feel Calvin and I made a lot of mistakes, and that's why I'm so passionate about giving back information in this way, because we could have bought a lot sooner, right? But one of the things that I think people forget, we've talked about pre-approvals, we've talked about financial planning, we're like driving this in with you guys on why these things are important for whatever you plan to do with your resources while you live in California. And for me, I know we've talked to quite a few of you about some side hustles that you have or second jobs or whatever, right? And when people, they make $100,000 on their side hustle or $50,000 on their side hustle, right? But they're not claiming it. They're not doing what they could be doing. I'm not here to tell you whether it's right or wrong, but I'm here to tell you, you may need to bite the bullet on paying more taxes one year in preparation to buying the new home, because what do we know about lenders? They're looking at your affordability based on the income that you claim. So if you're not claiming anything, that's going to be tough. So I'm just going to let Juan kind of touch on why that is critical and how that affects, because I know a lot of your clients, Juan, are realtors, right? So they are helping direct home buyers.
Right. Yeah. So, and then those are some great points. And, I'll focus obviously on the tax side, but one thing that I've seen countless times over the years and is, for example, someone doesn't qualify to buy their home in their name or without the help of a cosigner, because again, maybe they haven't quite handled their taxes properly. And what happens is, for example, I had another client not long ago. They purchased their home a few years ago. It was about $600,000. They had help from someone. So now that they wanted to refinance, remove that person from the mortgage and the title of the home, because they now had the income to qualify to put it in their own name only, they got stuck with the reassessment at the county. So we all have to pay county property taxes when we own real estate, right? And that rate is roughly 1.3, 1.35%, depending on your area and Melrose and all these different things that they tack onto the tax bill. So they went from paying real estate taxes on 600,000 up to $1 million, because that transfer, they reassess the home at the time of transfer, and that's considered essentially a sale, is what the way the county looks at it. And now they're paying taxes on an additional $400,000, which means they added about $6,000 to their tax bill per year. Multiply that out for 10 years and then 30 years if they own it for 30 years. They're looking at $180,000. And then we're not adding at if they'd invested that money instead, it would have grown a lot more. And I'm not a financial planner, so I won't get into where people invest their money. But point is, that action, for example, over the course of 30 years cost somebody a minimum of $180,000. Mm-hmm. And it's something that's super, super easy to kind of overlook. And sometimes we're just not aware of it. And like NECA said, that's why I love doing things like this, is helping people, recognize where the pitfalls are and then try to avoid them. But, to the other point NECA made, when people are self-employed, you really have full control over when you make investments in your own business. And you can time the investment to where if you are saying, hey, I want a lower tax bill, you can go make an investment that lowers your tax bill. Or if you're like, hey, this year I need to recognize more income, you push off an investment into the following year. And you're by having that liberty to control when you spend that money, when you take those actions, you're able to make some significant changes. And so the key here is really making sure that your tax professional understands your situation, and more than anything, your goals. Because if we know your goals, we can help point things out that are going to help you reach them. And we were talking earlier about the type of services offered by places that are only open during tax season versus year-round type service. A lot of times, let's say people don't have a financial advisor. And one of the things that I do is I'll work with clients, obviously the focus is their tax situation, but I help them understand their overall financial landscape to make decisions that help them be in position to do things like buy a home. So I could give you guys an example there. I had a couple years ago, I think it's been about 2 or 3 years ago when this conversation happened. They were newly married, both made a great income, and they both had student loans that were going to be due, where they were going to have to pay almost $4,000 a month in just student loans. So the reason, they reached out, they're like, hey, Juan, this is coming up in about 4 months. We're going to have to start paying $4,000 a month. And, we're thinking, when they got married, wife owned a condo where there was enough equity to almost pay off the student loans. So they're thinking, hey, what if we refinance, we pay off the student loans, and then we're able to write off the interest on our tax return? I said, that is a great idea, but if you refinance, use that money to pay off the student loan, you won't be able to write off that interest because you didn't use it for your property or for real estate. So we started kicking ideas, and the way I work in these sessions is there's no such thing as a dumb idea. Let's throw everything we could think of out there. And of course, some of it we might say, we're never going to think about that again, but at least it was something that was brought up, right? We kicked the idea around. So I asked them, hey, you just got married. Are you guys planning to have kids anytime soon? They're like, they look at each other. They're like, well, yeah, in the next couple of years. And then I'm like, how big is this condo? And they're like, it's a 1-bedroom. Okay. Do you think you guys might enjoy having 3 or 4 bedrooms? And then they look at each other again and they're like, yeah, actually, we would. And I said, look, everything has a cost, right? Like selling a home is going to cost somebody 5 to 7% between all of the various costs. But for example, when you own real estate, a personal residence, you're able to sell that residence and take a profit of up to $250,000 per individual. So in the case of a married couple, $500,000. So in their case, even though the property was only in her name because she owned it prior to marriage, the fact that they were now married qualified him to also meet the ownership and use test and also have $250,000 tax-free, right? Mm-hmm. So at the end of the day, what I was thinking in my mind is simply sell this property, not pay any income tax. Now, if they choose, they could turn around and buy that larger home that they're probably going to need in the next couple of years because they plan on having children. They're going to have a lot more space in the meantime, and they're going to have enough money left over when they sell this place to pay off the majority of these student loans and have enough to make a down payment on their new mortgage. Their new mortgage was only going to be about $4,500 a month, which was what, they're just the student loans alone were going to be $4,000 a month. Mm-hmm. So when you took student loans plus the mortgage on the condo, they were at over $6,000 a month living in a 1-bedroom place. Instead, they were paying $400 a month. They had a 4-bedroom house with a lot more room and a place that they could actually use once they had a family and everything else, write off the mortgage interest in its entirety. And all of these things came out of a simple conversation that
what they thought was a dumb question, right? Yeah.
Right, exactly.
So I love that, because I think I keep saying this, but what we don't know, right? So when I think about some of the sessions we've had before and some people that have chimed in, you might have property that's, going to be yours when your grandmother passes, or you have property that your parents are going to deed over to you and stuff like that. One thing that I thought was interesting is just understanding the laws around like how that, when you transfer that over, does it get reassessed? How does that affect your finances? What kind of taxes do you pay? All of that stuff. Let's pretend that is, that's the baseline. The problem is that as the different, and Juan, please correct me if I'm saying this wrong, but in my mind, it's going to make sense. So make sure I'm communicating it accurately. As administrations change, what people forget is those rules change. Just like my husband and I, we pay our children, right, as part of our business. It helps our taxes. It creates a savings for the children. Since we started working with Juan years ago, the rules on how much you can do per year changed. So again, the importance of having a tax, an enrolled agent, somebody that understands and keeps up with that information, right? Just like any professional, you want someone that's keeping up with that. You don't want to have to know what's changing about which laws that affect your situation, but having someone that understands those things, when you bring those, what we think are dumb questions, they can kind of think about it, and they automatically know all the implications that might affect you. So I think that's super critical with just having that open line of communication throughout the year to say, hey, this just changed. I was just deeded this property. Should I put it in my name or should I not? My husband and I saved a lot of money by taking on a family property, but not moving that property into our name because of, and I don't want to go in the weeds with this, but stated basis, or see, I don't even understand all of it, but the basis on
stepped up basis.
Stepped down basis. Yes. So, legally, we know we have ownership rights to that property, but he was able to tell us, listen, you don't want to affect the step up basis because this is how things are going right now with what is the proposition that just changed this past year that affected 19. Prop 19 affected that directly. And so my husband and I made the decision not to formally move that over, which all of these are legal decisions. And we chose to do an off record, legal document saying, hey, we own this property at this rate and all of that, and not affect title, which would cue a reassessment and which would change the tax basis on something that the family has owned for over 30 years. Right. Go ahead, please.
Oh, I just wanted to give a quick example of what that stepped up basis is and put some numbers behind it to really explain it and the power of how that helps build generational wealth. For example, here in Silicon Valley, my next door neighbor paid $21,000 for his house that's now worth $1.4 million. And that's common all around Silicon Valley, right? And what we see is, he's in his 80s. So at some point, his children are going to inherit. And so if he were to deed his property to his children while he's alive, his children will be treated as if they paid $21,000 for this house. So let's say he lives another X number of years when the house is worth $2 million, and then, mom and dad pass, and then the children now can do something with this house, although it's been in their name for a number of years now, right? So it's worth $2 million. They're going to be treated as if they paid $21,000, which means they're going to pay taxes on basically $2 million if they were to sell that property. They will pay federal income tax, long-term capital gains on $2 million, and then they're going to pay the state of California tax on $2 million. And the tax bill alone between the two is going to be nearly $500,000, actually more than $500,000, about $600,000 for having retitled that house into the children's name while the parents were alive. However, this is where stepped up basis comes in. Let's say mom and dad, the home is titled in their name all the way until the day they pass, and they leave a will or a trust. Trust is the best instrument, so let's just go with trust. They leave a trust saying, my 2 children get this home equally once we pass away. They pass away, it's worth $2 million. They will be treated by the tax authorities as if they paid $2 million for this house, even though mom and dad paid $21,000 for it. So since their cost basis now, that's what we refer to as stepped up basis, their cost basis is $2 million. They literally can turn around and immediately sell that house for $2 million and not pay a single penny in tax to federal or state. So just, I've had this conversation with at least 10 clients where they tell me, oh, I'm thinking of retitling into my kid's name. And of course, the values are all across the board for all the different clients. But under this example, for that one conversation literally saves this family $600,000. Just not retitling while they're alive and making it clear they're going to inherit once mom and dad pass and are no longer with us, and they're able, and of course it's more nuanced than this, but this is a high level overview of the power of stepped up basis, and that's why you have, tons of generational wealth in real estate, because, earlier we were talking about 1031 exchanges. let's take somebody who's been investing in real estate since the 70s here in Silicon Valley, when property was worth, $20,000, $30,000. And let's say they did a 1031, there is an unlimited number of times you can do a 1031 exchange. You could do it 2, 3, 4, 5 times. There is no limit. And fast forward to today, someone might now have properties worth $10 million and they've never paid a single penny in income tax in the entire time they've owned it, because they keep rolling it over as a 1031 exchange. And then if their children inherit these properties, the children will be treated as if they paid $10 million for them and not pay any tax either.
Mm-hmm. So I want, and you know what, let me.
Is that different?
Oh, go ahead.
Is
Go
that
ahead, Chad.
is that different than, is that why sometimes people will just deed the house to their kid so that this doesn't happen?
Well, you don't want to deed the house to your child, or else they won't get the benefit of stepped up basis.
Okay.
Yeah, and then the other thing that happens, actually, there's an exception. If you deed a home to your child, your real estate property, the county taxes won't go up from a parent to child transfer. But so at the county level, there wouldn't be an issue. But then the child, if they ever sold or when they sold, they would be treated as if they paid whatever mom and dad paid for the property, which means they wouldn't get that higher value of whatever that is when mom and dad pass away or when they inherit those properties.
Okay.
Yeah,
that was a good question. Can we?
Can I ask a question?
Oh, yes, please go ahead.
I understand that under this administration, 1031 exchange will cease to exist. Is that true?
Is that a
No.
rumor or is that true?
No, right now there's nothing set in stone, and so right now it's more of a, let's call it more of a rumor, because right now it's not in any legislation that's been passed, and all of that stuff's negotiable. And of course, anytime there's increase in tax, there's some major fights in Washington. But it isn't. I'm glad you bring that up, because it's always important to be aware of at least where the chatter is, because that's an indication of where they're trying to take things. But there is, for example, we've been talking about stepped up basis quite a bit here, and I've been using an example of $2 million. But there's chatter of limiting stepped up basis to $1 million. So, earlier I said, what if somebody had built a portfolio of properties over the last 40 years and it was worth 10 million? Right now, there's no limit to stepped up basis, and the children could be treated as if they paid current fair market value of 10 million, which means they could turn around and sell the moment they inherit and pay zero income taxes. But if down the road they were to pass that $1 million limit, the children would be treated as if they paid $1 million, and they wouldn't have a tax bill on another 9 million. And so if they were to pass those laws, they would significantly hurt, in my opinion, the very people they purport to try to help, which is all us regular folks whose wealth maybe is only in real estate. Because, and especially in our area, because in our area, I mean, everything is over $1 million. So stepped up basis would, no one would get full benefit of step up basis in our area. Maybe in a place like Central Valley in California, where a property is $400,000, $500,000, $600,000, it'd be fine, or the majority of America, but certainly not in some of the major cities like San Francisco, Silicon Valley, New York City. But good question. But right now there is nothing set in stone, and there isn't any bill seriously being considered that is going to change the stepped up basis just yet.
Thank you.
Does anyone else have a question to ask?
I do.
Go ahead, Chaz.
So is there any situations where you do want to actually pay the tax bill, right? Like instead of trying to figure out ways to prolong the payment of that bill, like as you get older and your income changes, what situation would it be where you would want to plan to pay the bill as opposed to do something like a 1035 exchange to delay it?
That's a great question. And that's where one of the reasons earlier I said it's important to know the client's goals. Let me give you an example. There's a client that NECA has had some conversations with, where she's planning to move to Texas to live near one of her children. She bought her home for $150,000, and I think value today is about $2 million. So she's got, we've had the conversations. What are your options? And I said, one thing is, don't sell it. Turn it into a rental, and then your children will inherit, and they won't pay any income taxes if they decide to sell it. And it's already worth 2 million. You're super healthy. You might live another 20 years. It might be worth 4 or 5 million by the time they inherit it, and they pay no taxes. And then she says, well, I wouldn't really want to be a landlord. Okay, so that's off the table. Then there's like these other programs, like something called Monetize installment sales, which we won't get into the details of that because it's super complex, but that's a way to push out the gain. But that would require, it literally probably costs $5,000 a year to manage a setup like that in just compliance fees. And she says, Juan, when I sell this house, I don't want to have to think about it ever again. So that's definitely off the table for her as well. She doesn't want to have to spend money or even think about the fact that she's got a piece of real estate that she sold. And in her case, when we run the numbers on what her tax bill is going to be on her profit, it's going to be a close to $400,000 tax bill. But in her case, she doesn't want to jump through any hoops. And so I'm glad you asked that question, because when it comes to tax, there's no like magic bullet. I've seen things online or even heard people say things in passing where it's almost like people think there's just, you do this one thing, the tax gets saved, and then you never look back. And tax is more like a flowing river. You have to be aware of how things are changing, and what you're doing is shifting, and you have to keep adjusting as well. And so when you look to defer the gain in some way, or you enter into a form, the majority of things will require follow-up and annual filings of some sort in order to avoid that tax bill or defer that tax bill. So if one of the things we're looking at is the client just really wants to deal with nothing, like this particular client, then it seems like, based on the pretty lengthy conversations her and I have had, it's in her best interest to just pay that $400,000 tax bill. The home's paid off. It's worth $2 million. She's going to probably spend, $140,000, $50,000 in cost of sale, $400,000 in tax bill. It's still going to leave her with $1.45 million in her pocket.
Mm-hmm.
And she won't have to think about the fact that she's got this property in California. She won't have to think about the fact that she's got to, deal with tenants. Like, she just doesn't want to deal with that. Then I have other clients that they're excited to deal with tenants, right? So that's where it comes down to the goals of every client.
So that I love that you brought that up, because one thing I just want to make clear is whether or not you decide to, stall or stretch out paying the tax bill and all of that, I'm here to tell you that whether you're selling or you're buying something, so let's talk buying. If you're buying something and you have legally gone into a situation where the IRS gave you a payment plan of some sort, in most cases, your lender is going to require that to be paid before you move forward. Okay, so that's A. Other cases, say you don't have a payment set up, and Juan has dealt with Calvin and I on this, so this is very near and dear to my heart. In other cases where you're like, you know what, I need 3 months to pay this or something. I'm going to take the hit on the interest the IRS charges me. It's worth it to me for other things I have going on. Again, if you're going to buy something, the lender is going to require that is paid. So now let's talk about if you're a seller. What if you're a planned seller? Or what if you're an unplanned seller? You inherited something and you need to sell it off. You need to understand that when they send you those seller proceeds, Here in California, title and escrow is required. That means that they are going to run a title report. That title report will tell them things like if you have back child support that you haven't paid, if you have taxes you haven't paid. So while you may think, I don't care, they can give me fees and all that, I don't want to pay my 100K tax bill, they will take it right out of your check. Okay. So those are reasons why when you're sitting here planning for certain things, some things can be unplanned, some things can be planned. And you need to understand that the government has found ways to make sure that if you want to buy or sell real estate, you're going to pay them the money that they want. Now, let me give you another scenario. And again, I'm trying to show you how most everybody on here can be implicated by some of these things. It's not just about if you're buying something or if you're selling something right now, it can affect other areas of your life. We were in a situation recently where we had a large tax bill, like our tax bill is kind of merged with our business stuff and our personal stuff, right? And we weren't even able to get a response from the IRS right now because of COVID. And we're in the middle of refinancing 2 properties and buying our new one. So again, there's just reasons why it's super, super important to be proactive on these things and understand, because I mean, there's so many companies right now that aren't even answering their phones. So if you think any of these things are going to affect you, it's really important that you engage a professional that's going to help you. And I know most of you were on the call maybe close to a month ago with the financial planner, and you can see a lot of things are consistent here, right? He talked a lot about, he had a client that got a bunch of property, and then as he turned 50 or something, started giving one of them or each of them to a grandchild or something. How he did that was really important for him to know how to do that strategically, and working with a tax person and a financial planner to understand the implications on both sides is super important. Does anyone have any other questions? Please, video on and mics on. We want to hear from you and see you. I love to see faces. All these like video off, it's sad.
I have another question.
Hey, Lakita. Hey, who's talking? Monica, go ahead.
Yeah. Can you talk a little bit about the tax advantages of having, if you have a side hustle, or even if real estate and buying property is your hustle or business, of having an LLC or an S Corp, or what kind of tax advantages do you have with setting those up?
Great question. So one of the things that I teach continuing education to other tax pros across the country. And one of the points I always pound home to my peers is, when they get this question, always tell people about the cost of compliance, because all the tax pros are really great about telling you how you'll save money, but then they forget to tell you about what it's going to cost you too. And the last thing you want is to advise someone to, let's say, become an S corporation, where their cost of compliance might be more than they're even saving. And in that case, then what was the point of becoming an S corp, right? It's costing you more money than you're saving. So, kind of high level overview, when somebody is an S corporation, what it really means, and I have, I'm not, again, it goes back to everybody's individual goals and priorities and financial condition and where they expect to be in retirement. And the reason I say these things is, when somebody is an S corporation and they are lowering their tax bill via the S corporation route, what it typically means is they're funding their Social Security account. Legally, this is permissible at a lower rate than they would if they were just a sole proprietor. So the reason that's a good thing is you pay less taxes now, and then you could go invest that money, and maybe you make that money grow a whole lot more. It gets a lot bigger than it is giving it to Uncle Sam. But if somebody takes those savings and just spends it, again, I can't judge somebody. I can't judge someone's choice and lifestyle, let's say. But then, future them, when they're 65 or 67 or whatever their retirement age is, and if they haven't contributed to their Social Security fund like they could have, and they also don't have a pension or a significant 401k or something like that, they're going to have some really tough retirement years, because Social Security is not going to be enough to survive, at least not in our area, maybe nowhere in California, right? So when someone is an S corporation, you're able to, let me give you an example with some numbers. Let's say the profit of the business is $100,000. If you were a sole proprietor, you would pay tax on $100,000. You would pay federal tax, state tax, Social Security, and Medicare, 4 different taxes. When you are an S corporation, you're able to take that $100,000 and split it up into 2 buckets. One bucket will only pay Social Security. One bucket will only pay federal and state taxes. The second bucket will pay all 4 of those things I mentioned, which is federal, state, Social Security, and Medicare. So the way you get these savings is the bucket that only pays federal and state tax. On that bucket, you are literally saving 15.3% on whatever that number is. And that's how that leads to savings over time. So going back to the question, so what are the benefits? The biggest benefit is that you can save on taxes, which specifically means you save on Social Security and Medicare tax, which is 15.3% of whatever that number is, or that profit number is. The downside to it is you're not funding your Social Security to the level you could be funding it. But if you're good with your money, you're investing it, you've got all other goals you're trying to accomplish, there's nothing wrong with that, and that could be a good route. The second piece, super important, which is where I said I always tell my peers, make sure you're telling your clients what this cost of compliance is there's a lot of things that need to happen. The accounting needs to be correct tax accounting. There needs to be an accounting system. There's going to be an extra tax return, which is an S corp tax return, then your personal tax return. There's going to have to be payroll. And when you add up the cost of doing all these things, it's a minimum of $7,500 a year in just compliance costs, plus the state of California is going to charge you another $800. So you're going to spend about $8,000 just to be an S corporation. And so at that point, what needs to happen is you need to save more than $8,000 for this to be a benefit to you. So what that really means is the profits need to probably be larger than $80,000 in order for people to start seeing a tax benefit that exceeds the cost of compliance.
So that brings up, let me stop before I go into something to comment on what you just said. Does anyone have any questions for what he just said? That really should resonate with people that have a side hustle, are building a business on the side, trying to gear up to quit corporate America. That's really what he's talking about there. Before I even quit corporate America, his guidance on telling us to get an S corp way before I even thought I was ready for that saved us tens of thousands of dollars. Of course, I didn't know that till after, but I trusted him, and he, I felt he knew what he was doing, and it was a really, really good decision. So again, structuring, whether it's sole proprietor, just keeping it as an LLC, S corp, C corp, it all depends on so many factors. Your information, what business type it is, like he mentioned, profit. So anyone that has a side hustle or is looking into those things, does anyone have any questions for that?
I actually do. I'm curious of this might sound like a simple question, but what is a good base percentage you should take out of any paycheck that you get to start funding this process?
Process of tax prepping? What do you mean?
Process of building up of tax processing, and then also to gain your next home, really, or start that process.
So I think that's not necessarily a tax question, but I have this conversation with clients all the time. And my opinion is, look at your monthly cash flow, right? What are your needs? And obviously needs need to be covered. And then we're going to look at what our wants are. And then those wants, we probably don't want to give ourselves all the wants, or we'd spend all our money. But that's where then you set budgets, and then everything you could save. For me, I'll tell you how I personally do it is obviously I cover my necessities, which is food, mortgage, car expense, insurance, and obviously all of my business expenses. And then I have pretty strict budgets for myself on other things. Now, I don't stop myself from going out and having fun, but I also don't exceed, certain limits every month, because as much as I earn, I want to put as much of it as possible into investments, because we need our money to grow for us. I mean, I don't know if how much you guys have been paying attention, but I'll tell you, I love me some carne asada and I love me my pollo asado. And before the pandemic started, I could go down to Chavez supermarket and I could pay $2.50 a pound for chicken and $8.99 a pound for some good carne asada type meat. Today, chicken is almost $6 a pound and the carne asada is about $15 a pound. So if we're just keeping our money in cash and we're not investing it, whether it be real estate or you have a financial planner and you guys are doing mutual funds or whatever you're doing, it doesn't, I'm not a planner, so I don't tell people where to put their money. But what I do tell people is it cannot be in cash, because as homes appreciate, for example, you will be left behind. I mean, again, NECA is the expert here, but from just my outsider's view and dealing with my clients, I've seen that the average cost of a home in Silicon Valley has gone up by like $300,000 to $300,000 over the last 12 months. So what does that mean? You have a lot of times I see people say, oh, I'm holding off on purchasing because I'm trying to save for a bigger down payment. Well, if they didn't save 200 grand last year, they kind of were walking backwards, because now that same house cost an extra $200,000. And if they didn't save at least $200,000, they fell further behind. If they did save $200,000, well, they actually could have just bought a year ago for $200,000 less, and they would have been in the exact same position. So that's kind of my 2 cents is save as much as you possibly can by looking at your discretionary spending.
So you guys know what I'm going to do right now, because this screams Farallon. So get off of mute, please, my love. Just from what
she's coming for you.
Yes, I love your wisdom. So I need you to chime in, because everything you just said, it preaches to everything that you say about, you need to invest, you need to figure it out, you need to do. So can you give us some knowledge? Tell us what your thoughts are on what he just said, how it relates to taxes, maybe, with what you've dealt with taxes and all of your wisdom. I would love for you to share.
Well, Juan, actually, I probably couldn't have planned that any better, because that philosophy lines up very nicely with my own, which is, for those of you who've attended multiple sessions, what we've been talking about is how hard it is for wages to keep pace with the price of assets and investments. So if you have a job, it is great. If you have a high paying job, even better. At the end of the day, it is less likely that your income through working is going to grow as fast as any money that you put into the stock market or into the real estate market, because in real terms, from 1970 until around now, wages have essentially been stagnant, or they've increased 1% to 2% per year. Assets have increased by dramatically more than that. And right now in the COVID pandemic actually is one of the exciting times, because wages are there is wage inflation, pretty dramatic wage inflation, particularly at the lower end of the spectrum, which is great, because most of those folks have really been left behind in the economy for decades, literally. But your job, should you want to be wealthy, is you have to convert your income to assets as fast as possible. That's what Juan is talking about when he's saying, yeah, I let myself have some fun, but I think about my income as like, what are those dollars going to be worth in the future? What kind of tree can grow if I plant the seeds now? And this moment in time right now for investing is just really, really, really critical. I recently was a beneficiary, exactly what he's talking about, buying then instead of waiting. And it's been, game changing. We just moved, thanks to NECA's help, from our condo into a single family house. Now, square footage of the two is the same, but single family houses benefit quite a bit more from price appreciation, particularly in the Bay Area, because there's just a scarcity of housing. So a single family house will do more. Did it make complete sense to buy that condo? Absolutely. Would we have been able to afford this house this year without having bought that condo 18 months ago? No. I can tell you emphatically no. The gain that we're expecting on our condo is $300,000.
And she's been
I
there.
mean, you need
I don't
you
know
need
if
an IPO or something like that for it to work out in 18 months like that. It's very real right now, and people are truly being left behind. I don't want anyone on this call to be left behind. When we were doing comps and even looking at the block on our cul-de-sac, we saw that, you know what, the person who owned this house, who sold it to us, he bought it in 2008 for like $680,000. When we thought about, okay, well, where were we then? Could we have afforded that? Actually, probably, but it
Yeah.
never even occurred to us when we were that young to like get some little tiny, 1,000 square foot house. This guy, he added a little bit onto it, but it's like, he bought like a 970 square foot house. I wasn't even thinking that way. That could have made a huge difference now. So the time is now. I also say this with the utmost caution. Do not to go out and buy a house you can't afford, because that's not the game either. I am not asking you to go and, starve yourself to death to get into a place and lose it. That's terrible. What I am saying is, with real urgency, you buy something, and you buy something that you can afford, and you buy it as soon or as close to now as possible. And the idea that you're going to just, move into your dream house, that works often for folks who live in Oklahoma. I don't think that works so well here. So I think that that's kind of the salient part about building the wealth through real estate. I was taking a couple of notes, and so I'll give some other notes. In general, yes, we are talking about ways to be efficient with our tax dollars, ways to avoid taxes. Tax avoidance is very legal. Tax evasion is illegal. And at the end of the day, there is a fundamental truth that everyone in here needs to keep in mind, because should you become wealthy, and if you start to transition up the tax brackets, one thing that you do really have to keep in mind is that if you make money, you will pay taxes. This idea that somehow you're going to have a tax bill of zero, if you are successful at it, you're either going to be Elon Musk, or you're going to be in jail like Wesley Snipes, and potentially our last president. Literally, for most circumstances, and I'll tell you how Elon is paying no taxes, because he's borrowing up to his eyeballs in debt, and he's not selling any of his assets. So if you were comfortable, he's clearly a high risk person, but essentially what I'm telling you is, yes, he's worth, more than $100 billion. He has almost nothing liquid in assets, and he's got lines of credit everywhere, borrowing against all of his shares. Most of us don't have the stomach for that level of risk to do that. That's just very counterintuitive. I'm not really sure it's that bright in the long run either, but that's what he's doing to have no tax bill. Otherwise, what you're doing is you're lying. And sooner or later, the more income you make, the more attention people are going to pay, and there's just not a way around that. The next thing I want to talk about is kind of like two levels of, tax and professional help. For folks at the lower end of the income scale, the vast majority of those people should not be paying for tax preparation. And there's actually, free softwares and things out there for that. But really basic, lower income situations, I've heard of people paying a tax preparer $400. You shouldn't be paying a tax preparer $400 if you make $40,000 a year, like in a regular job. I don't think that's the best use of your money. The 1040 easy exists just for you. Secondarily, a lot of these franchises make money based on services for people who cannot defer their own gratification. So what am I saying? Do not ask for the instant refund from H&R Block. That actually costs real money. You wait until you actually get your refund.
Which is like
Secondly,
less
if you
than
want,
10 days anyway.
yes, come on. Do not pay them, 100, 150 bucks so you can have it today.
What do
That's
you
just silly.
mean? I want it now.
I know, because you got to, go on your refund vacation or something. Don't do that. Secondly, if you're someone who is getting a lot of money in refunds and you have like a regular job, that is a sign that your withholding is incorrect.
Mhm.
And what you are doing is giving the government an interest-free loan throughout the year.
Exactly.
Couple $1,000, okay. 15, no. Right? I think one can say it better, but I think one withholding is somewhere between $2,000 and $3,000. So you're talking about like multiple exemptions that you should be claiming that you're not claiming if you're getting $10,000, $15,000 back every year. Lastly, we've been talking about the cost of financial mistake. Juan, I just want to put you on the spot. Your average client, how much are they paying you annually for the service?
So that's a great question, and you are putting me on the spot. So my average fee is in the neighborhood of about $750 per year. Now, of course, there's some that are a lot higher than that, and then there's some that are a bit under that, but it's probably in that range. And I'm glad you asked that question. And the other thing, though, that I want to mention when it comes to tax prep fees, you're not wrong when you say somebody earning $40,000 a year maybe shouldn't pay anything. Maybe they could do with TurboTax or something along those lines. But let me paint a little bit of a different perspective on that as well. So I've had clients where it's a couple, let's say, they each make $40,000 a year. So combined, it's $80,000, and it's real basic, just a W-2. But like I said before, I advise my clients throughout the year on what's going on in their life. And I've had clients that way where we're like, okay, how much can you put into your 401k? Can you take advantage of your company's dependent care benefits package? They didn't even know their company offered that. So they were able to take $5,000 tax-free through that method. Hey, what about that HSA? Do you have an HSA? I didn't know I could do that. And so we start adding up all of these different things where my advice literally saves them, $5,000, $7,000, $8,000 a year, even though they're only making, $40,000 each. That fee of $500 or $600 is more than worth those savings, because once I do that for them the first time, they see, hey, wait, you know what? This guy's helping me save money, and it's going to be, 10 years before I pay him in fees what he saved me in year one.
Mhm. Well,
I
think
agree,
that-
but you're also not H&R Block. So I fully support that. I'm
No,
not
but
sure that's what the average person is getting out of, showing up at those situations. But I
agree.
directly asked you your fee because I did want to have that conversation where we're talking about being penny wise and pound foolish. And many of the things that Juan is describing on an annual basis cost much more than his service fee. And having that information is valuable. I would say the vast majority of us, myself included, and if you're not in this category, maybe you should be starting your own financial series that the rest of us will attend. The vast majority of us are fully capable of wasting $750 or making a mistake that costs dramatically more than $750. That's the point that I'm making, because I want us to really think about, okay, what are our goals? Who can help us get our goals? And anytime that we're spending money, not just for our own happiness and indulgence and on bills, really what you have to be thinking about is, what is the long-term value of this dollar that I'm spending? Is it worth it? And that happens no matter what the price of something is. It's the wise person is constantly making a determination of, is it valuable to spend? Am I getting the value out of what I am paying? So I just checked my notes, and I would say the more complex the tax situation is, the more that you actually really do need a professional. And it's important, and try them out, see what you learn around something like that. I think that's all I have, Nika. And I
Farallon,
probably talked too long.
no, you're fine. I have a question for you. So would it be fair to qualify that statement a little bit more? And, I think the income that you're making is one piece of it, but like Juan has kind of pointed out, are there other, are you inheriting something? Do you have a house that, is passed down to you, or something like that complicates your taxes a little bit more? So it's not only about what income are you bringing in, but what other potential assets or classes do you have in the background? Would it be fair to classify it that way, so that people understand, like, when is it time for me to get someone that is actually going to advise me more than doing the 1040 easy?
Well, let me put it this way. Here's when you should stop working with someone. If you show up there and they don't tell you anything new, you have all the information that they need to file your return. There is no investigation or interrogatory going about your situation, then you probably could have done it yourself using tax software, because that person is not helping.
Adding value. Yep.
They're not adding value. So if you were able to just clearly anticipate and show up with everything they needed, and they're like, oh, this is great. Boom, 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 boom. Please pay me $300. You probably shouldn't have been there.
Yeah. Yes.
I don't know, Juan, do you agree with that?
I do. I agree with that. And I think the only caveat to that is if there's a specific transaction that needs to be reported a certain way, like maybe the sale of a personal residence, TurboTax won't do a great job of helping you figure that out. So maybe that year go to someone, but in general, yes, accurate statement. The other thing I'd like to add is anytime you need tax advice, go to your tax person. Don't call NECA, don't call your financial advisor unless they're an advisor / tax professional, but go to your tax person, because sometimes, everyone's well-meaning. No one's intentionally trying to mislead in any way, but because there's so much you have to stay on top of, maybe they feel like, oh, let me just give you that quick answer, and because that way you don't have to go chase around your tax pro or find a tax pro, and then maybe it's not incorrect, and then there's a problem, right? And the last thing you want, especially like Farallon said, something that for a tax person might be a super simple answer, but for a non-tax person could literally lead to a mistake that costs 10, 20,000 bucks. You want to make sure that mistake doesn't take place.
That's a good point, because it's, a lot of times we go to our inner circle and we ask these questions, and it's not that they don't want what's best for you. It's not that they don't have the right answer, but they don't know everything about your file. In real estate, I get people that ask me, what are the closing costs going to be? I quickly tell them, your lender needs to be making that very clear to you. I don't know what your lender's fees are. I don't know all of these things. I can estimate for you, but that means nothing. So you go to the person that is responsible for those numbers. And unfortunately, you cannot always trust your best friend's advice, because she's going to give you information based on her situation. And even if you give her all of your information, she doesn't work in that field. So I really love that advice that you gave, because I think sometimes we want to, trust our inner circle, and I don't care what they're doing with their lives and how successful they are. They don't know your full story. So yeah, you got to go to a professional. I had a couple notes. Oh, go ahead. Sorry. Please. No, go ahead.
So a good tax advisor, you're saying, will sit down with this person. A good one will try and understand your situation and goals, right?
100%.
I mean, I have one who, I pay probably about that much, but who just takes my information and prepares it. Then if I have a question though, he'll ask for, I can ask him, but he doesn't proactively say, okay, what are you trying to do? It may come up, but I'm going to him with the question, and then it may come up. So but a good tax preparer, you say, we'll try and sit down with you and understand your total picture.
Yeah, I mean, I could
Yeah.
explain my process briefly if that helps.
Yeah.
So it starts with, I give everyone a tax organizer, and it's like 24 pages. So it can be overwhelming. But what I tell people is, don't feel like you need, let's say you're W-2, don't feel like you need to transcribe it onto my tax organizer. If you have a tax document that's going to give me the info being requested in the organizer, just give me the document, totally okay. But anything that you don't have a tax document for, or any questions you have, that organizer does a really good job of giving you a place to put those things. And it isn't that I won't follow up. It's just that when you do the data dump to me, I'm able to see all of your documents plus the data that you feel is relevant. Then what happens is I do a review, I work on the return, I'll reach out and say, hey, these are my follow-up questions. And then that usually leads to some sort of conversation. And then I complete the return to where we think it's done. We'll set up a Zoom call like we're doing today. I'll do a screen share and I'll walk you through your entire tax return, line by line, explaining it to you. And then that also helps you ask more questions, and it makes sure we don't miss anything. We're able to catch mistakes. We're able to double check things, if you would. And then from there, we have the conversation of in this process, what I learned about you and things I think might help you. And I'll give you whatever those thoughts are. And obviously it's also throughout this, 30-minute Zoom or whatever, however much time it takes us, you have the opportunity to ask me questions as well. And then as things come up during the year, you reach out as well, and I answer those questions based on whatever that is. So that's what my process looks like.
I love what he just mentioned about that organizer. The reason why I love it, and I'll tell you, as it's been several years since we've used him, I need that less and less. But in the beginning, I loved it because he's asking questions I would have never thought related to anything about taxes, right? So it opens your mind to start answering the questions and saying, oh, okay, so he's going to look into this and maybe there's some way that I can benefit from this. So I think that's super important. And Monica, I would say, in my opinion, I don't think you're abnormal. I think most people, including my mother-in-law, including my mom, definitely in the past have used people where it's like, just send me your documents, I'll have it done for you and I'll mail it back, literally. So I think that is I believe from what I've seen that is the norm for people. So maybe there's a market for that. There's people that have done their own taxes. Sorry, go ahead, Carolyn.
Well, what I would say is that's a tax preparer. That is not someone who is giving you tax advice.
Good point.
They are helping you comply with your legal obligation to the tax authorities to do a tax return. They are not helping you strategize or save money on your taxes, plan for the future. So, and actually, I'm glad that came up because that's mostly what I'm talking about when I'm saying don't, spend a lot of money in those areas, because I don't really think that that's where you get the value. I think you get the value when someone asks you questions and when they actually give you advice. So I've had, tax professionals who at the end of it say, they cheer me on for all the things I'm doing right. So they'll say, it's so great that you maxed out your 401k. I'm so happy to see that. Yes, I love it. Yes, I love that you tied. Oh, by the way, next year I need you to do this, or make sure you do this next year. They'll make that clear. And I had one situation where to Juan's point, I was loyal to a guy for several years because he gave me very good advice that I was not able to capitalize on at the time, but it taught me a lesson. So my family is not wealthy, and I am probably the wealthiest person alive right now. And I have a kid brother who's 10 years younger than me. And so his first year of college, he got a lot of scholarship and then nothing. I mean, just like the minimum. And my husband and I made up the difference for him to be able to go to school. Well, when he was going to his senior year, we finally got this tax preparer And I said, I don't understand why. I mean, he's poor than dirt. Like, why can't he get, money for school? And he was like, well, what address does he use it? And I was like, mine. And he's like,
Oh
that's why he can't get
no,
money.
they're
And
alive.
I said, but wait a minute, I'm not his guardian. He's like, schools have ways of seeing the tax returns attached to addresses.
Mhm.
And I can tell you that that's part of the reason. And in general, for a young adult to be considered independent, he was like, in Texas, I think the threshold is you need to hit like 12 or 13,000 bucks. So
Mhm.
rather than paying his bills for him, it is better if you would have paid him, given him a 1099, let him pay taxes on, $13,000, because then it's believable to the government he's independent. And then he would qualify for a lot more aid. Well, I didn't have the time to do that. So
Mhm.
that's, one of, I guess, probably a dozen examples that have come up so far around how someone can actually help you plan and strategize. Because, by the way, since he's not, I mean, he's loosely a dependent. I mean, I kind of made it work, but there weren't the same level of deductions for him like it would have been if he was like my actual kid.
Yeah.
So I think that's what we're talking about. We're talking about actual strategy and planning, and not just preparing returns that don't have errors.
Mhm. Mhm.
So one aha I wanted to point out too was, I don't know if you guys noticed it. Monica was just one example, but I've seen this many times. If you notice, when she was speaking, she mentioned she pays around that, right? So if we think about this, there's a tax preparer, and sometimes they're charging just as much as the average of what a enrolled agent, someone that's strategizing, right? How Fairlawn just described it. Because of this ignorance in the community to think that this is what it is. Someone just takes my information and does it. That's what it is, right? But we're here to kind of tell you, no, there's more that's required and necessary and beneficial to you. And it could cost you about the same thing, possibly, depending on your situation. I want to get to a couple of these questions in this chat. The first one I want to get to, actually, let me do this one. Let's revisit the paying children thing that I mentioned. So Juan, if you can talk to us about what that is currently, how often it can change, because I know it just changed maybe a couple years ago, and why that can be beneficial to an individual or to someone that has a corporation or LLC, how that affects everyone.
So when you pay your child, I think the most important thing to remember is they have to be doing something for you. You can't just say, I'm going to pay my child. They have to be providing your business a service of some kind. And obviously that can vary by age, right? If they're 15 years old, maybe they're doing your social media marketing. Maybe they're, responding to emails. I don't know, whatever that is. But if they're smaller, then it's things that a younger child can do, right? Are they the models in all your brochures? What is it that the child is doing? And then a lot of these things have a huge range on what you would pay somebody to do this work for you. So you have to try to arrive at whatever those quote unquote reasonable numbers are. And that's the number one thing. And then you want to document that in some way, as you would any employee, whether it be by the job or by the hour or whatever it is, have that documented. And what happens right now, for example, you could pay a child, well, the value of their services could be unlimited, but from a purely tax savings perspective is on the federal side. If they earned about $12,400, they literally pay zero income tax to the federal government on $12,400. And if the parent is in the, let's say 30 something percent tax bracket, then the parent is saving 30 something percent on $12,000, which is basically $4,000. So as a family unit, you're saving $4,000 by employing that strategy. Now, California's threshold isn't as high. There'd be a tax bill in California of maybe just under $100, but you're paying California $100. You're paying for a simple tax return, so that'll cost you a little bit of money. But big picture, as a family unit, you guys are saving $4,000. Actually, that $4,000 is just on the federal level plus California. So as a family unit, you're probably saving $5,000 to $6,000 depending on the parents' tax brackets. And then even income, if it's a teenager doing more work and you're paying them $20,000 or $25,000 a year. Well, even at the rate of $20,000 or $25,000 a year, they're still probably in the 12% tax bracket or 10% tax bracket, whereas the parent might be between federal and state at 40% plus, which again, you're still having a major difference there in tax bills. So you are paying something, but it's at a much lower rate than mom and dad would. So here's another thing, and this applies more to like a college student. College students, all of these principles still apply, except for college students, you would still have to pay Social Security and Medicare tax, where you don't have to pay that for a child 17 and younger. But let's say you have a college student and you guys are doing this. Not only are they earning income and not paying tax on the first 12,000 bucks and anything above and beyond that at a lower rate than mom and dad, the Internal Revenue Code allows you to pay up to $5,250 towards college tuition for an employee, and the business is able to take a deduction for that entire $5,200, and that's also not taxable income to the employee, which means there's a $5,000 deduction and no one pays tax on that money. And again, if you're in a roughly 40% tax bracket between federal and state, somebody just saved over $2,000 in taxes just by doing that.
Can that make them ineligible for Pell Grants though?
I'm not a financial aid advisor, but I know college students can work and can earn money. I don't know the threshold at which they then don't qualify for certain aid. That part I can.
Yeah.
So one thing I want to say, but I also kind of have a question with it. Juan, as it relates to our children are younger, so we have accounts with their names on it, but obviously they don't know about it. But even our older kids, we do this for them. And while you have that account that has their name on it and you pay them legally and you show the proof and all that, you don't have to literally give them that account. Like I'm not saying this to say then you use it for your own thing, but I'm saying this to say, for us, we're doing this yearly, trying to do it yearly. We skipped 1 year kind of by accident, honestly, and using it as kind of a college fund. I do recognize there's other better college funds that are going to be better than just cash sitting around. And we're definitely looking into those too and making sure we do the right ones. But for us, they're so young that it's going to build so much. And honestly, when we're thinking, and I always like to correlate this with building wealth through real estate, right? One of the cool things, and I know Fairlawn can speak to this, is when you're getting a really good loan, they want to see seasoned money. They want to see seasoned funds. And because our kids are so young, those accounts we have for them are linked to our larger accounts. We're on those same accounts. Our kid's name is on there, and it's considered part of our overall seasoned funds, which helps with our reserve requirements for purchasing, right? So I'm just kind of giving you, like, tying this all together to say, especially for those of you that have young kids, it's a great savings plan for them. It's a great way to show seasoned money that sits in an account that banks really love. They love to see money in an account for longer than 2 months, right? So before I even kind of stop with that statement, is that accurate, that especially when they're young, that money sits there? It needs to be in an account with their name on it, but obviously they're too young. You're not passing the money over to them.
Yes, and then to take it even further, you could actually open an IRA and fund an IRA. You could. Yeah, with those funds, you could then open that 529 account, which is specifically for higher education savings. So yes, as long as they're tied to that account in some way, like you described, totally permissible. And like you said, it's not expected that a 12-year-old has control over that amount. So, and actually, no one under 18. I think you always, because I did that with my daughter. She just turned 18 recently. When she was underage, we didn't go to every bank in the world, but we checked with a couple. They all required me to be the main account holder with her as like a sub account holder. And so that'll always be the case anyway. But yeah, you want to make sure it's an account with your child's name where the funds are deposited to, so that you show that those payments took place.
That was my next question about real estate, NECA. As far as seasoned funds, they don't care whether it's checking, savings, 529, IRA, as long as it's an account?
Yeah,
They
so
do care what it's invested in.
Yeah.
I just had all these conversations.
no, she's absolutely right. And to clarify, just on, I'm gonna let her talk more, but just on what you said, when I'm talking season funds, and please, Farrell, you'll correct me and chime in here, but season funds, I'm focusing on your cash because they're very picky about, you have a friend that's going to give you some gift funds. They want that to go through proper channels. So if you're going to use that as part of the reserve requirements, which is in addition to your down payment, and we've talked about this on prior sessions, we can get back into that. You want to make sure that you understand that season funds is that cash that's been sitting there at least 2 months for most banks. Not all banks require this, but some are very strict. You get the better interest rates with those banks that are more strict. Farallon, do you want to chime in?
Yeah. So for the purposes of reserve requirements, they care about the asset itself. So, and cash doesn't fluctuate in value unless you spend it. So that's why NECA's saying that that this money for their kids sitting in a cash account like just adds to their reserves and makes it easier for them to get financing for additional properties or what have you. Cash also doesn't earn very much. If you have your assets invested like in, stocks or bonds, then it takes a quote haircut because the market can take a dive. The price of these stocks you own are fluctuating every day. They're not going to count that as 100%. The lender that I just used, they counted it as 70%. So they would say 70% of the value in an investment account that's not cash is what we will count as your available cash. Now, to take it a step further, they absolutely will not count anything that they call illiquid or unmarketable assets. So if you have RSUs in a private company, even RSUs in a public company that haven't been exercised and turned into stock, that gets you a zero. Now, what I don't want you to think is like, oh, that means I shouldn't do it. No, in the long run, it actually makes a lot of sense to keep your money invested in the stock market. We're just talking about for the purposes of getting a loan, what they consider is collateral that they can, use to believe that you can make a down payment or that you could make up some unexpected expenses, because that's where they're going with the whole reserve thing. They want to know that you could liquidate things fairly quickly and still be able to pay your mortgage. That's the point. That's where they're going. The second thing, I love how NECA's already planning for her kids, and she's got this thing going, and Juan has mentioned several things that he's done. What I want to say, and I was late to the call, so I do provide financial advice for a living. Most of the clients I advise are high net worth folks, and many are highly concerned about the access that their children have to accounts. Many do not tell their children about the investment accounts that they have. And so what I want to say very clearly to all of you is planning for your child's future success does not mean that you cede control. So paying a salary to your child does not mean that your child is in control of the money at all, by any stretch of the imagination. And yes, a child cannot be the entire owner of a bank account. It's a custodial account. If you turn it into an investment account, it's called like an UTMA or UGMA account, like Uniform Transfer Act to Minors. Now, when they turn 18, that is their money. So you have to be careful about whether or not that's a vehicle you want, where as opposed to a 529, you retain control. And if your child's not, let's say they're not, prime time ready to go at 19, well, now they don't have an account that has $200,000 with their name on it. It's your name. And if you are not writing the check for tuition, they don't get it. There are ways to transfer 529, to another beneficiary. So I say all this to say that being afraid that, oh, okay, I don't want my kid to know about this money is not a reason to do it. And I don't want you to think that you lose your parental control by helping your kids build wealth. You do not. Many ways to do it, quite frankly.
And just on that note, love that you went into that more. When we have one for our oldest who's 20 years old, and we have a good relationship with her, so she, lets us know before she spent, this, that, and the other. But one thing that's important, and I know you guys know this, when you set up a bank account, you can have it be an or account or an and. Just like when you buy a car, is it an or an and, or all of that stuff. So when you do this, for me, it was important that it was an and. Even when my child is 18, she cannot go into that bank and do anything without them asking, wait, where's NECA, or wait, where's Calvin, right? So she's absolutely right. This doesn't mean that it's just their money and, you have to use it for you have way more control than that. This is a way to save for your kids, obviously do whatever you want that pertains to them, but also use the tax piece of it to benefit your finances. So one thing I want to make sure and get Juan to give us is advice. All of us, call Juan if you need his services, if you're in the if you need a new tax advisor. But my question to Juan would be, what are some, like, maybe 3 or 4 questions you would say are important for people to ask a tax advisor when considering someone to work with?
I think first and foremost, ask yourself what level of service you think you need. And you might not know, and that's okay. But at the very least, if you've got a situation that's more straightforward than a W-2, like you want to buy a house, or you have a job where you have stock options or RSUs, or you've got, all these benefits that a lot of the companies here in the Valley offer, you probably need somebody who can explain them to you. And I'm not talking about your HR department, although they're a great resources, but they're not going to tie it all together for you. They're just going to answer the one specific question you ask them. Mm-hmm. And what you need is kind of like for lack of a better term, maybe like a financial coach who also is looking after your tax situation, right? So that's number one, is what service do you think you need? And then second one is, very first question is, do you offer this type of service? Because I loved what Farallon said. A lot of tax pros just want to prepare a return. There's nothing wrong with that, and they're really good at it, but they're not going to add much more value than an accurately prepared return, and that's kind of it. Mm-hmm. So if you're looking for somebody who's more of an advisor, you need to seek out and find the person who offers that service. Because again, somebody who only wants to prepare returns is not going to do a very good job at the advising you part of it, mm-hmm. if they even do it at all. So I think those are two super important questions. And then the other thing is, just, at least for me, is I'm always telling clients to be forward looking. What's your 3 to 5 year plan financially? And always have that at front of mind, because especially if you're self-employed, there are probably things you can and should be doing to work towards those goals. Maybe, and I'm not saying, having a job with a W-2 is bad in any way. It's just that there is much less flexibility. What I describe to clients is, think of these like levers. And if someone has a W-2 job, there are far fewer levers than if somebody's self-employed, full-time, earning all their money via their own business. Then all of a sudden, there are a lot more levers we can move around to manage things, right? So I think those are the main things, right? Understand what you need. Make sure that the pro you're working with can service that need, and then ask yourself your 3-year goal, and then 3 to 5 year financial goal. And then the other thing that's super important is just if you are already in a certain industry that's kind of a niche, then making sure that, again, whoever you work with understands that industry, because that'll be important as well. They have to be familiar with the way your industry works in order to really understand what your needs are as well.
That's a good point. Mostly for business owners and sole proprietors. Okay.
Yeah, even wage earners, right? Like if somebody, just today I got 2 referrals from other tax professionals, from people who have stock options, and they just don't deal with taxpayers, mm-hmm. who deal with stock options, for example.
Interesting.
And yeah.
That's a good point, because that is a lot in this area too. Does anyone have questions for that? I want to close up, but I want to mention something about Juan and his services. But does anyone have any questions? Okay, so one of the, I could have said this in the beginning, but it's a nice wrap up. One of the things that I thought was super intriguing when we first started working with Juan is I knew that his background was in helping get people out of trouble, right? So, and Juan, please stop me if I'm telling your story wrong, but he actually, do you want to tell your story about the tax problem and what your main goal was, especially in the beginning, and how you help people get out of audit problems?
Yeah, absolutely. So the name of my business is The Tax Problem, and it's because, you know, I've helped a ton of people either settle massive tax debts or reach installment agreements, payment plans that are very favorable to them, to where sometimes they pay a fraction of what they would have paid the IRS otherwise. But, you know, some examples I've settled $350,000 debt for as little as $100, for example. Like literally, the taxpayer paid $100. The debt went away and they were able to move on with their life. I've had clients where they had over $100,000 in debt, and the payments they made to the IRS from the moment we started working together to the moment the debt was gone was less than $5,000. So I've helped a lot of clients navigate the collections and audit area. And you know, obviously we're not doctors, we're not saving people's lives, but from a financial perspective, we're certainly doing some pretty neat things. And what I mean, you know, the reason I use the doctor reference is all of us can clearly understand why we would never go to a pediatrician if we're suffering from cancer, because the pediatrician would literally kill us. They could do nothing for us, right? That's just not what they do. They don't work with cancer patients. So when it comes to tax problems, it's kind of a similar thing, but fortunately not from a life and death perspective. If somebody has a tax problem, they're going through an audit, things like that, your average tax preparer that just prepares tax return, and even if they've spent 30 years preparing tax returns, they probably have no idea what they're doing when it comes to an audit. And because it's a specialty and it takes a different skill set, and the way you do that is completely different than the way you prepare a tax return. So I got into this area because of law school, really. You know, it's all about defending people and its representation. And oftentimes, unfortunately, even when a taxpayer is right, the IRS kind of runs them over. But when you have a representative that can say, actually, you're wrong, and here's the law that supports why you're wrong, or here's the case that says why you're wrong, then if they want to tell me I'm wrong, it's not about telling Juan he's wrong. It's about saying Juan's research materials are weaker than their materials. And if they can't prove that, then they have to accept my legal precedent that I'm presenting to defend my client's position, right? So I got into this area just because I saw there was a huge need. And again, Farallon said, I come from a very, the term I use is very low information household. My mom has a second grade education. I was the first in my whole family to even graduate high school. So when we look at, even preparers in our communities, it sometimes, at least what I saw was I didn't like the level of service they were offering our community, and one of the things I really liked about when NECA asked me to come on this show is she said there was a lot of information that she could have really done a lot more, a lot quicker if it had been at her fingertips. And when she said that, I mean, that's exactly how I feel and why I chose to go from only preparing returns to focusing on defending people, which to do that, you just have to be really good at figuring all this other stuff out, which then also naturally is part of planning and everything else, because that's how you defend an audit, you plan. So.
Mm-hmm. So what I want to just point out there with everything you said is, let's be clear, he's built his business around helping, defending people in these audits. These are audits that were caused by someone else that did the client's taxes, right? So I'm not saying his clients that he's worked with didn't have issues. That's not what I'm saying, but primarily they're coming to him because, hey, listen, I have a tax issue and I owe this much, and Juan wasn't the tax preparer. So when I've known his story, because like I said, I've known him over 13 years and I worked with him in tech, but I thought that was cool because I don't want to break the law. No amount of savings is worth me jeopardizing my family, my finances, or my license, right? So for me, I want to be as strategic as possible, save as much money as possible, make sure I'm prepped to buy homes and buy investments or do whatever I want to do. But I don't have the time to learn all that stuff because I don't do it for a living. So what better person, at least for me, than someone who, it's almost like you're reverse engineering, right? He understands how people get into trouble and how to get them out of it. So therefore, as he's helping me be more proactive, he's going to help me be as strategic as possible up into that limit to where, this might be legal, but it's going to make you a red flag to the IRS, right? So I don't want to be a red flag because the minute, and Juan has told me this before and he can articulate it better, but the minute you get audited, whether it's a little bit or a lot, you're kind of on their radar in the future. Is that right, Juan?
Kind of. I mean, they're going to look at a number of years, and then that door just kind of stays open if there's an outstanding liability that's unpaid.
Yeah. Yeah. So I hope you guys found this beneficial. I'll definitely send everybody his information on an email so you can reply directly to him if you have any questions. But if no one has any more questions, I just want to say how grateful I am for this community. Farallon and I, and Regina, she couldn't be on today, but Farallon and I are super grateful for all this. And I'm going to let Farallon close it out because she's probably going to make you guys promise that you're going to actually take action from this seminar. So go ahead, Farallon.
Yes, I'm very action oriented. It is. So yeah, here's another speech I've given a few times. It's not what we know that matters. It's actually what we do. And if you will take actions, even just a small action, it compounds across time and the results are huge. We're always looking for these dramatic changes, but the best and the most durable changes actually happen in increments. And it is not fair to ourselves to expect, a masterpiece overnight. You start where you are and you take a step and you take another step and you take a step after that. So today is August the 25th. There are 3 months and change before the end of this year. That means that you do have time to do the planning that Juan talked about, that this tax year has to be planned for in this year. There's not much that you can do on a retroactive basis come January 1st, 2022. So I think we've highlighted a lot of nuggets. I think we tried to focus on the ways in which taxes impact real estate purchases, because that's a large part, that's the focus of this financial session or this financial series. And we have the tax person come as our last speaker. This is very important. So I want each of you to take 10 seconds and come up with an action that you can take. And I want the barrier for this action actually to be very low. I want it to be something that will take you less than 30 minutes to do. And if you can think of a material step you can take that takes 2 minutes, that's even better.
Can we put them on the spot and make them tell us?
Yeah, actually, it's the last class. Why not? Yes,
Let's
we'll go around the room.
Bola.
Let's do
Bola,
it.
what's your action? Oh, you're on mute. You're on mute, love. We'll come back to you, my love.
Nope.
Kofi and Erica.
Can you unmute people,
Oh,
Snecka?
yes. Oh, yes, I can. I'm sorry.
Just unmuting.
I didn't know I had to. Hold on. Ask.
That
Oh,
might
it says
help.
I have to ask him to unmute. So I just asked you.
But if you ask him, then maybe he clicks the button.
Okay, try now, Bola. No.
Oh, is
Yeah.
that working now?
There you go.
Yep.
Okay, sorry about that.
That's okay. So what's your action?
What I'm gonna do, I'm definitely gonna look into funding the account for the kids, and also, oh, sorry, for the child, and also, and also looking into for like future projects, especially out of state, what we may need to do, or what's the best way to plan for our next investments. So
Love it.
How much time are you going to spend on that?
on this, well, we're kind of stuck in the project right now, so nothing's going to be happening until this
Okay.
project's done.
So
but
you have,
we're
so if you
planning
have
right
not met the criteria for the assignment, I need an action that will take less than 30 minutes.
now.
Woo,
Okay.
girl.
This is real. And the reason I'm saying this is because everything you said was lovely. And then the minute I asked you about how much time it takes, then I hear all the other things that have to come before it. So
Okay.
in action, 30 minutes or less.
What's it gonna be?
Well, definitely check on Jordan's account. That's
Boom.
something we started and seeing if we can leverage more of that. So I can do that.
Love.
Like opening his bank account? Is that what you're saying?
Well, we already have UTMAs for him.
Oh,
but
so you have the UTMA. Okay.
we have the UTMA for him, and we also have a brokerage account connected and the savings account, as well as what's it called, a regular checking account. But I do want to look into connecting that to the real estate, and then also looking deeper into 529s as an option as well.
Love it.
That will also take longer than 30 minutes. The first half is believable. It would take you 30 minutes. The question of like, how can I connect this to real estate? I think you can get that done on Google and have like a few actions.
Love it.
Once you start adding, the rest is less is more.
See why I love her?
She'll get there. That's
She'll put
great.
you
I
on
just want to make
blast.
sure you do this first part.
We
Yeah.
will, definitely.
You know what?
Okay.
And this is being recorded, so I might send you messages and make sure that you did it. All right, Kofi and Erica, you know the rules now since Bola was our test dummy. So
And I'm such an enforcer. Sorry, Bola. You went first, but I am definitely have
What
this
is-
policeman
blame
part of my
Emo.
personality.
Yes, yes.
I know.
You can handle it, Frat. I know you're
I
fine.
got it.
I love it. Kofi, Erica, what's yours?
Yeah, well, given that we just spent the past 6 months learning the hard way about the difference between a tax preparer and a tax advisor, we will be calling Juan very soon.
So you're
Get
saying
used to this face, Juan. You're gonna see us.
You're
Just
saying
know
this
that.
webinar is 6 months late. That's what I'm hearing.
Oh my gosh.
Okay.
Yes.
All right. Farallon, I know you said this is our last one, but it sounds like we need to reach more people. Okay, good. So that's an action. Zach, do you have an action? What are you gonna do?
So I actually have a nephew and two nieces who are entering adulthood in their home buying journey. And I have a goal of asking them how they plan on creating their financial success at such a young age and what that really means to them right now. You know, they're at an opportunity where they can really start building a great
Good for
amount
you.
of wealth. So yeah, I think that's a very valuable question.
I love that because we all need to do more of that, talking to the young people and reminding ourselves that when we were younger, we wish we did certain things. So let's tell them what those things are so they can do them. Love that.
Absolutely. Yeah,
love
they should
that.
they need to know. So let's talk to them. Yeah.
Yes, I love it. Okay. Cece, you want to come off mute and tell us what your action will be?
This is perfect because on my list of things today was like I have a list of people I need to connect with to move my ball forward, and it was CPA. But now I know that
Woo!
might not be what I think it is. I will also be reaching out to Juan to get my affairs sorted immediately, so all the money that comes in forward has a place to go and a job to do.
Love it. Love, love, love. And, you know, Cece is a realtor and she just started Onyx Wealth coaching. And so that's going to be perfect because Juan deals with a lot of realtors. So good for you. And Monica, what is your action? Oh, you're on mute, love. Oh, do I have to do the thing again or?
No, you already did.
Yeah, I think I did. There you go.
I just said Juan's getting the business and I'm making my call. Want that fill out that 24-page organizer. I'm ready.
I already knew from your question and from talking to you in the past. I'm like, ooh, Monica, you need to call him.
Are you up late tonight?
She might actually call you tonight. No, I think that's great. I think
Oh,
you
let the
guys,
man get some rest. I did say there's 3 months and some change. Or you could queue up the email and fire it off.
love it. Love, love, love. And Monica she was doing and is doing some investment out of states, and she's got some stuff here. So I know you're gonna get a lot of knowledge from Juan. So good for you. Chaz, who, if everyone doesn't know, is my younger, more adorable sister.
Oh, okay. You
She's
are
the
my
older-
sister.
She's the older sister. Okay. All right. They know now. Okay.
You wish. You
Go
wish.
ahead. What's your action?
Mine is, so I have an UGMA account that I started for my daughter at Fidelity like years ago, and now I need to go look at it and see how that's all set up. I don't know what's in it. I need to go look at that. So that's going to be what I'm going to log into my account.
That
Because
is
it's
a
just been sitting there.
fantastic goal.
Look at
You
that.
probably could start logging in while people are still sharing their goals, and you could be done.
She might check in on you. I think we actually might have a progress report after this. Farallon, what is your action that you're going to do?
Believe it or not, actually, I think I'll reach out to you too, Juan. We will be selling a property we did not own for 2 years. So I want to see if we can do better than long-term capital gains. And I want to see how much I can jack up the basis of this condo. So I'll be reaching out to you for some advice around that.
I'll just go next because that was what I was going to say. Farallon's husband, we will be reaching out to you.
I don't know. If I were Farallon, I would say that doesn't count. You have to have your own.
Well, that's what I was planning. That was my own. The difference is my focus.
Stole it.
Farallon stole it from me, but actually I wasn't thinking about the sale. So that's good for her. I was actually more thinking about, just overall, I mean, I think we've upgraded our tax advisor already, so that's good, but a second upgrade doesn't hurt. I want to think about how, equity might factor into things, RSUs, into tax strategies moving forward for my family. So
love it.
Yeah, and our problem is that for the most part, we're high income W-2 earners. So we regularly ask these questions and people basically tell us there's nothing you can do.
And in all fairness, sometimes that's the answer, although it's not the answer people want to hear, but yeah.
Yeah. But I think Farallon, it's pretty clear that you're always kind of making new moves financially and stuff. So I think for future investments or future things that you might have your eyes set on, it might be wise to understand more about your total picture. And Nika, do you have an action? You want to come off mute and share? Okay, I'll give you a moment. Nicole, do you want to come off mute and share your action?
Sure. I think the first thing that we need to do is definitely reach out to Juan. My husband's industry has been impacted by the pandemic, so we're like on one income right now. So a lot of things are not in our purview right now. So it's just going to be about rebuilding, hopefully his job opens back up soon. But it's given us a fresh perspective in terms of how to, the amount of planning that we need to do, for both the businesses that we want to start, but also the income that we have and the tax issues. So it definitely has been very informational, even though a lot of the, information doesn't pertain to our situation right now. But I mean, I'm just really, I have a lot of hope. I can say that.
That's fantastic.
Love it. Shannon, what is your action? I'll come back to you, Shannon. Oh, Shannon, go ahead.
Okay, so I have a home in Texas and I'm going to visit with Juan to find out what I need to do about that home.
The home you just spent 2 weeks in Texas for? Yeah, good for you. I like that one. And Rosalind, what is yours?
Oh my gosh, on the spot.
Hey, you.
I was cooking earlier, so I was multitasking. You know what? I'm going to combine this with the last session I believe I was on, and I'm committing to better tracking my expenses every month. Every month that I sit down to do my bills and kind of look over everything. When Juan was talking about your needs versus your wants, I need to commit to doing that because NECA, you've been on my mind to talk about buying, and I'm like, I'm not prepared. I don't feel like I have, enough of my monthly expenses kind of laid out to even broach that conversation. So yes, better tracking my monthly expenses.
Here, Fairlawn coming up.
Rosalind, how are you? Yeah, because that one is way too big. It can be big,
Well, you
and
already
you can
do
make
it.
that very hard on yourself. So, which is why it doesn't get done, right? So there's a way to do that where it's like the burden is high and you won't dig in. How are you thinking about tracking your expenses?
People have tried to share like apps and all of these things, and I'm thinking seriously just doing an Excel doc.
Don't do that.
No, okay, well, please help.
And if you've tried an app, have you tried an app and you don't like it?
I haven't. I think it's just I get so much information that even like choosing which app to me is overwhelming. So
this is exactly why I asked this. Okay, so
love it.
I have 2 simple steps, and I'm going to offer them to you, and I want you to tell me flat out yes or no. No, it's fine. We just need to get you something that'll take less than 30 minutes to complete. Okay. What I'd like you to do is separate your spending. So if you have 2 accounts right now, that's perfect. I want one account to be the account you pay all of your bills out of, and nothing else. Nothing discretionary gets paid out of that account. So mortgage, utility bills, anything that's like a monthly, quarterly, even annual bill, that can come out of that account. The other account is going to be an account you use for discretionary things. And in my book, discretionary actually includes groceries and gas, because you actually have a lot of control over how much you spend in those categories. Okay. So the other account is discretionary. I want you to fund it with what you think you spend on discretionary items, just whatever that number is. Okay. And the reason I want you to do it that way is because that is a self-tracking mechanism without you having to go and itemize everything in a little spreadsheet. So if your thought is like, after I pay all my bills, I probably spend, I like round numbers, $1,000 on food, gas, and going out for the month. Then you put $1,000 in there and you see how fast that $1,000 evaporates.
Right.
And as part of that discovery, you're going to start to see, well, it'll be a lot more, it'll just become a lot more apparent, and it has the feature of the control. And with the controls, I mean like the gate, like you will know when that suddenly doesn't have money. Mm-hmm. And if you're like me and you're a spender, those 2 accounts should not be at the same bank.
Mm-hmm. So you can't transfer. I love when you said that last time.
Yes, there's no instant transfer. I actually need you to if you're running out of money, you need to have to think about it. It needs to cause an inconvenience. So you can think about, okay, what's going on? Now, even when you do that, just keep in mind, Rosalind, it actually takes about 3 months to accurately understand how you spend money. So expect the mistakes. That's fine. And every month is different and has different things. But start here, and you can get more sophisticated later should you need to. But all you need to do right now is split up the 2, because what I'm hearing is that you don't feel like you know what you spend. Mm-hmm. So take out the fixed expenses, have an account that's the discretionary, and then you'll start to have an idea at least of what the total number is, because that matters a lot more than, oh, how much coffee am I buying? Mm-hmm. And did I shop online? That's incidental. The real point is, are you able to maintain a certain level of spending so that you can afford a mortgage, right? I'm guessing this is where this is going.
Yeah.
Okay.
Not
Does
that she
that
needs any
work for you?
backup because she is the queen of finance, but those are like such words of wisdom that have taken me a long time to learn. And that's like the best advice I've ever learned. So, Caroline, like I said, not that you need it, but absolutely the best words of wisdom I've ever gained. So I will take that one, those words of wisdom to the grave, Caroline. That's great words of wisdom.
So I don't do it that way, but so I'd like to just hear your discretionary bucket, what you put in that. Like, so you just said like Amazon or any credit card bills if you shop at Macy's.
Oh
Like
yeah, I was actually trying to keep it really simple. We start, right? The important thing is to start and follow a system. I find it very difficult to like track apps, and I think people get busy. It's not part of their nature. There's some shaming that starts happening when you start having to categorize things. It has a utility, but often it folks stop before they can get the value. So if she's not a person who wants to use apps, then that's just not going to work.
yeah.
But if you're asking
Go
about
ahead.
discretionary,
Mhm.
I'm basically saying any expense that you have a lot of control over, I would call discretionary. So you don't have control over your mortgage. You know what that's coming. You've got to pay your car insurance. You know that amount. Look, technically, yes, you have control over how much you turn your lights on, but when that bill comes, you have to pay it, right? Water too. So fixed bills and fixed expenses, even if they have some variability, that needs to be one account because that's like your overhead. That's the cost of your living. That's what you can't change so easily. The other stuff is discretionary spending. So yeah, you need gas in a car to run it, but gas fluctuates based on how much you're driving, what you're doing, which choices you're making. So I usually keep gas as discretionary. I usually think about groceries as discretionary because you can go out and you can say, you know what, it's Thursday. I'm gonna get lobsters, or we're gonna have prawns. Or you could say, I'm gonna buy dried beans, soak them, and make an awesome chili for $15. There's a wide spread there. So for simplicity, I'm saying just have the two accounts. I actually have way more accounts than that, but the way that I do adhere to this is we have a family discretionary account that everyone has a debit card to. It gets funded every 2 weeks, through payroll, and then it's very obvious whether or not we're overspending or not because that account just, has a balance. Like, oh, it's this much time until the next time I get paid. This account's not getting more money, so I guess we can't continue to go to our local pizza spot or order out. It's going to have to cook. It's just like a basic way of kind of trying to restrain or be aware of the spending areas that you control.
Okay,
And I'm happy
I'm
to
gonna
talk
be that
more.
guy. We're
Emo wants us
way
to go to bed.
over. We're way over. Baby needs to go to sleep. So
Oh,
can we
and
make sure we
can
hit
as a
the
plug.
people? Can we hit the people that
Yes.
haven't given their thing and then
I think everyone has
wrap up?
some.
That's everyone. That's everyone.
Okay.
So Juan, I wanted to thank you, Juan, so much for being here. I will send everyone an email so that they all have Juan's information. It's in the chat function. I'll leave this open for people who want to look at it. But thank you, thank you, thank you. I so appreciate you all.
And
Thank
if
you,
you
guys.
love this event, sorry, Juan, and I'll let you wrap up. If you love this event, we're hosting a financial fortitude workshop on Saturday, October 23rd. A lot of the people you've actually seen through this series will also be there speaking at their different professions and different financial areas. So please, please, please look out for that. I just put the link in the chat. It's a virtual session. Come out. Juan, I'm organizing along with others. So Juan, I might talk to you about if it's not this year's, getting involved in a future one. So thank you so much for your time today. Thank you for everyone who participated, and look out for our financial fortitude workshop. Click on the link, register, it's free. Even if you can't attend, we record it. Really amazing content. All right, to you, Juan, and then we can.
I just wanted to thank everyone for accepting me here tonight and for participating. Lots of great questions, and I really had a great time getting to know a little bit about all of you. So thank you.
Thanks, Juan.
Bye-bye.
Bye, everyone. Thank you. Good night.